the 80 line. So also when we are buying, we also want the divergence to the stochastic to create a divergence while touching the over the 20 line, which is the oversold line. And when selling, we want it to touch the 80 line while selling from there. So now in this case, if you compare those 2 points, we could see that, okay, there's a difference of what is actually happening between the market and the stochastic. And in a normal way, things are like this. If you can see between this point and that point, and between this point and that point, you guys can see that this is a normal way. Sorry. From this point to that point, the market was going up. From this point to that point, the market was also going up. But when you find a situation like this, from this point to that point, the market is going up. From this point to that point, the market is going down. That's what we call divergence, which is the total opposite of whatever is happening between the market and the stochastic. And now from there, what we're going to do is that we're going to enter a buy here immediately after the crossing. So these two lines, immediately after they cross, we're going to execute a buy from there. And sorry, from there, if you would have executed the buy to where the market is currently is right now, you would have made some very good money with just this movement. From there to there is too much money from there. Now, just gonna go back to this. So from here, you entered your buy there, the market will go up. And as it continues going up, we know that the market doesn't move in a straight line. So of course it will make re-entries on the way. And those re-entries, you can just also simply, retracement, you can also simply implement the re-entry strategy again, so which is divergence that I showed you, in order to add more trades to take it up. So an example, let's make an example with this trade. So from there, after you enter buy here, the second divergence, it'll be from this point to that point, from this point to that point. So you can see you're seeing it, you're looking at a totally different thing. And after the crossing over, you're gonna pile up your trades again from there. And as the market continues going, you're gonna use the same principle, divergence. You can see from here to there ascending, and again from here to there it's descending. And there, like that, and simply from here to there, from here to there, it has crossed to the upside. So meaning another trade is supposed to be taken, going up like that. So now, from this, you must be able to draw your footprint and first layer, because the $1 million question is, when are you actually closing a trade? You cannot hold trades not knowing how long you will hold it, of course. Now, in order to determine when we're going to close, we're going to draw, let me delete everything, a footprint line here. And after that, we're going to draw a first layer line here. So if this thing decides to continue going up like that, it will mean there's more profit for us on a table, because of from there, we'll get to extend our first layer line. And as we extend our first layer line, the market goes into more profit. And immediately when it comes in break, we'll close all the buy trades that we would have taken from there. Because we know that when the market breaks the first layer, the market is about to go into the opposite direction from there. So just like with the same example here, that was your footprint. You can use that as the first layer. Since from there was a clear divergence and the market has been going very good from there. I mean, on this time frame, the first divergence is from here to there, and yeah, from here to there. So you're seeing the total opposite of what is actually happening between the market and your stochastic. So now I want us to check out a pair that we can jump with. Okay, what we can use here is this one, but here the market hasn't broken up this line. So I want us to look for something that is very clear. If you're not seeing a footprint, if you're not seeing something that is clear, don't force yourself to see something that is not there, okay? Because you'll end up making mistakes. Oof, this one left us. We're supposed to enter a buy because there was a very beautiful footprint. After there was a very beautiful footprint, a very beautiful first layer, we could have entered with a divergence there. It moved, we would have been some nice profit, which can be very good for a lot of people in just one day. So from just here to there, but it's fine. Let's go to the next one. We normally look for the trades that we can be able to see, okay, that these ones, like these ones, they're at the point where the divergence is about to happen. That way, so that we enter at the right position. It doesn't help if you don't find that kind of a trade, you go into different time frames. So you'll always find that kind of a trade. There's no way in all the pairs you want. It's impossible to not find, because the footprint is how the market moves. It is definitely how the market moves. So check it out. There's nothing we can do here. It already left us too much. This one has already left us too. Nasdaq, we could be looking at something here. On the sell. So yeah, for Nasdaq, it is time to sell. So this one doesn't need a ruler, so it is very much clear. This pair, I think we're about to buy this thing. The reason I'm saying that is, oh yeah, definitely. Definitely. The reason why I'm saying that is, if you can check, let me go to 30. There was a very clear divergence, footprint, very clear first layer, and from there, I was supposed to enter here or there. Now, when we go into a much detailed form, from this to there, the horizontal line. So it makes sense to buy. In the same time, I want us to extend this line. It hasn't fully broken there to a point where we can be satisfied. And from 1 4 hour, you're just seeing a regular divergence. So this will be some sort of like a divergence for the footprint. We will have this divergence for that footprint on 4 hour. So, okay, guys. What we're going to do now, just like the last time, we placed the XA, was it the XA GUSD? We're still going to do the same also on this one. So What you should what you guys should do now, let's buy this thing. Let's buy this thing now, and yeah, we'll just have to wait for it to kindly respond. But for now, let's buy it because we must not postpone buying, entering, because if it moves, we can't hold our heads when it's too late. So right now, let's buy. If you have an account, start executing now, and I'll show where we put our stop loss. We enter here, we put our stop loss there, a little piece below, and we expect the profit to be around there, knowing that in a way we'll be able to spot the first layer line and take it from there, because the reason why we put our stop loss there is because of if the market goes below like that, we can no longer be able to draw a footprint line, because connecting those 2 points will be like that. And we want a situation where we draw a footprint line and it becomes like that. So if the market comes here, we know that that's a failed trade. So okay, let's execute now. And I'm also going to be setting a signal for this thing. Mm, it's, okay, 4, 5 times 6. All right. Yes, this is okay. The spread is a little bit big, so you guys must accommodate that, okay? Because the spread of this pair is not like any other spread. It is quite heavy. So don't just go all out to a point where you exhaust your free margin, because it can disturb your trade. Let me buy USD ZAR. And signal just got sent. Now, from here, I just have to wait for this thing to respond. There's NFP, I believe, today. So right now it can just move. When NFP comes, it will just can give us a continuation, or it can just move the way on its own. But we expect the news to even follow us on that. There's no other
Before
way.
you move away from that ZAR there, can you please draw for us that horizontal line there?
Okay, okay. Yes, So right now, we're hoping this to be our footprint, right? As we're hoping that to be our footprint, in order to fully confirm that that will be our original footprint, we have to put the horizontal test here so that when the market goes above here and make a retest, we can confirm that it's the footprint, as the footprint that we have. Because normally what happens is that you can confirm that your footprint, and the market normally likes consolidating like this. Find that sometimes the market just consolidates like this. And after it breaks there, you'll find out there's a new footprint. But here, some can actually think that the market that is breaking and they will close their trades, so it will disturb their trades. So an example of what I'm trying to say, let me do this. Let me go to a random pair. Okay, there we go. Now, that's the footprint, and you can use that one as a first layer, right? Then from there, no, actually, this is not a bad example. This is not what I'm actually looking for, because of here, if you can be able to draw your footprint from there and be able to draw your first layer, even though you place the buy divergence, after the first layer gets broken, the market did go down according to the footprint. And after that, it went down. Footprint in the other direction also happened. So this one, it makes sense. So I'm looking for a situation where, let me go to another pair. I'm looking for a situation where the market was giving us a consolidation to a point where it was very hard to tell where we can draw actually the footprint line. And we draw it without any knowledge, and the market breaks that footprint line, and we thought it is eventually breaking the whole thing. And we get disturbed with the trade. So let me check this thing out for now. What is that? Okay, perfect. There we go. Some can use that one as a footprint, and some can use that one as a first layer. You guys can see, it's fine. From there, what we normally do is that we put our first layer, our horizontal line, here. This is not a vertical, a resistance or support, to just a horizontal test line in order to determine where we'll be able to draw a proper footprint. Now from here, imagine if I have entered a cell here. After I enter a cell there, and I immediately draw my footprint line from there. did you see this breakout that happened? I would think the market will go up. After I think the market will go up, yes, I was going to see flames. But if I would have used and see that, okay, well, from where I've connected my first layer, the second point of my first layer, you see there was some sort of a cup there. So I want a situation where it comes in, breaks. That's when I can be able to draw a footprint line. Because of I couldn't draw a footprint line.
Oh, Brian, sorry to disturb. What
No
do
problem.
we, what should we exactly draw the horizontal line? Like, 'cause
So we draw the
I don't know
we
why you
draw the,
put that. Uh,
so we draw it from where you're actually entering, or from where you're actually like connecting the dots. Because of, let me give you an example. Sometimes it happens in different levels. So you find a structure like this is fine. And from there, the market gives you a benchmark or where and from where you're going to be entering a buy. And also depending on where you extended your first layer line. What I'm trying to say is that let's just, if you enter a buy here, do not immediately draw a footprint. Because sometimes you can draw a footprint and the market will just consolidate like that. So what you do, sorry, from there, what you do, you wait for it to cross that line. After it crossed that line, knowing that you be effective with that extended line, naming it as a footprint. Now, in terms of where we're drawing it, you find situations where from here, let me try to make sense about this. This way you draw your footprint, a footprint line. I'm assuming that will be your first layer at that particular time. So immediately after the thing breaks. Yeah, so we must use this one instead of this one. What I'm saying is that from where we've actually entered, if you're the first trade you took it there, you draw your horizontal line. Here. And if you wait for the thing, this thing to be broken, that's when you know where you will also extend your first layer, footprint line from there. But even though you would have extended it, it would have still given you some trouble here, thinking that this thing is going into the opposite direction. And now it comes into a play of the kind of time frame you're implementing it on. Because, for example, let me give you an example. If you go into 1 hour, 1 minute, and after you look at 1 minute, and you are able to spot each and every single movement that you have to spot at a particular time. Let me give you an example. even though, let's say you would have gotten your divergence there, and you put your horizontal line at around there, it's fine. The market will break, but if you're dealing with a structure where you're on a bigger time frame like that, you'll see the market in a different form, in a way that